You look at the silver chart, episode 12, and you feel pain. You missed the bottom. You missed the breakout. You feel like the train has left the station. But the smart money knows a secret about commodity cycles. The metal moves first, the miners move second, and the miners move harder. Right now, we are witnessing a historic anomaly. Silver is up, but silver miners are still trading at valuations from 3 years ago. They are lagging. This creates a coiled spring. The market hasn't priced in the new reality yet. When silver goes from $30 to $35, it's a 16% gain for the metal. But for a miner, that $5 increase goes straight to the bottom line. It can double their profit overnight. This is called operational leverage, and we are standing at the exact moment where the leverage kicks in. If you miss the metal, you have a second chance to catch the explosion. But be warned, this isn't investing. This is dynamite fishing. Let's do the math on why miners explode. Imagine it costs a mining company $25 to pull an ounce of silver out of the ground. Labor, diesel, insurance. If silver is trading at $26, they make $1 profit. Boring. Nobody wants to own that stock. But if silver goes to $31, the price went up roughly 20%. But the miner's profit went from $1 to $6. That is a 500% increase in profit. The stock price will chase that profit growth. This is why junior miners are the call options of the resource world. They offer massive leverage to the underlying asset without an expiration date. For the last 2 years, inflation hurt them. Diesel was expensive, labor was expensive, but now the metal price is rising faster than their costs. The margin expansion has begun. The smart money is buying the cash flow machine before the quarterly earnings report comes out. But you can't just buy any miner. You have to understand the life cycle of a mine. The legendary Pierre Lassonde mapped this out. It's called the Lassonde Curve. Stage 1, the discovery. A tiny company drills a hole and finds high-grade silver. The stock goes vertical. 10x, 20x gains in a month. This is pure speculation. Stage 2, the Orphan Period. The excitement fades. Now they have to do the boring work, permitting, engineering, raising money. The stock crashes and sits dead for 5 years. This is where retail investors sell in despair. Stage 3, the construction production. They build the mine and pour the first bar. The stock re-rates as a real business. The smart money plays this curve like a fiddle. They buy the discovery, stage 1, sell the hype, wait 5 years, and buy the orphan, stage 2, for pennies right before production starts. Most retail investors do the opposite. They buy the hype at the top of stage 1 and sell the bottom of stage 2. Don't be the liquidity for the pros. Now, the warning. This sector is a minefield. There are 3,000 junior mining companies listed on the TSX Venture Exchange in Canada. Maybe 100 of them will ever build a mine. The rest are what we call lifestyle companies. These companies exist solely to pay salaries to the management team. They drill a few holes every year to keep the dream alive, issue new shares to pay themselves, and dilute you to zero. They are serial diluters. You own a smaller and smaller piece of a pie that never grows. The smart money looks for skin in the game. Does the CEO own shares? Is he buying with his own money? Or is he just granting himself free options? If the management team isn't suffering with you in the bear market, they won't let you participate in the bull market. Location, location, location. Geology doesn't care about politics, but investors must. Most of the world's silver is in Latin America, Mexico, Peru, Chile. Historically, these were mining-friendly jurisdictions. Not anymore. We are seeing a wave of resource nationalism. Governments are looking at the rising silver price and saying that belongs to the people. They are raising taxes, canceling permits, and threatening nationalization. Look at what happened in Panama with First Quantum. A massive copper mine was shut down overnight by protests. The smart money is actively exiting risky jurisdictions and paying a premium for safe jurisdictions like Nevada, Canada, and Australia. A high-grade mine in a country that wants to steal it is worth zero. A lower-grade mine in a country with rule of law is a fortress. So what is the catalyst for the explosion? M&A, mergers and acquisitions. The major miners, the Barricks and Newmonts, are running out of reserves. They haven't spent money on exploration for a decade. Their mines are dying. To survive, they must buy the juniors. They are like starving giants looking for a meal. When a major buys a junior, they usually pay a 30 to 50% premium overnight. We are about to enter a consolidation supercycle. The smart money tries to identify the takeover targets, the juniors with high-grade, large deposits in safe places. They buy them and wait for the phone to ring. It is the ultimate lottery ticket. You own the asset the giants desperately need. If picking the right junior feels like gambling, that's because it is. The failure rate is 90%. So how does the smart money play this without blowing up? They use the basket approach. Instead of betting on one horse, they bet on the track. They buy the ETF, like SILJ, Prime Junior Silver Miners ETF. This gives you exposure to a basket of 30 to 40 companies. If one goes to zero, which it will, the other two that go 10x will make up for it. This removes the idiosyncratic risk, the mind flooding, the CEO stealing, and leaves you with the sector risk, silver price going up. If you believe silver is going to $50, you don't need to find the next unicorn. The basket itself will likely double or triple. It is the get-rich-slow way to play a get-rich-quick sector. Let's summarize the investigation. The silver miners are a high-octane leverage play on the metal shortage. The smart money playbook is aggressive but calculated. 1. Allocate responsibly. This sector is volatile. A 5% allocation can drive your entire portfolio return. Don't bet the farm. 2. Focus on quality. Look for producers or developers with permits. Avoid the hope and dream explorers unless you are an expert. 3. Watch the costs. Look for miners with all-in sustaining costs, AISC below $20. They make money even if silver drops. 4. The exit strategy. These are not hold forever stocks like Coca-Cola. They are burning matches. When the cycle peaks and everyone is euphoric, you must sell. We are early. The crowd hasn't arrived yet. The slingshot is pulled back. This is the smart money wisdoms. The future belongs to the owners.